So today we're going to be talking about mergers and acquisitions in 2024 and beyond, right? And it seems like every time I do this panel discussion for Marty, the winds change. They've been changing a lot over the last few years. So, for example, back in December 2023, you were hearing things like PitchBook reporting corporate acquirers scooped up 151 seed stage startup companies last year in 2023, the lowest since 2017. M&A of more mature companies fared a little worse during that time period. They fell to a 10-year low. Now we fast forward to quarter end of 2024, quarter one. Dealogic is reporting that M&A volumes climbed 30% globally, driven by the U.S. and Europe, where it jumped up a hefty 59% and 64% respectively. The key industries for that were, technology, finance, energy, and life sciences. And those industries combined were up 42% over the last year to a total of $153 billion. So that was just Q1. So that was very positive. Forbes separately reported that oil and gas mergers hit a record for Q1 levels in 2024 with $51 billion of transactions. And Forbes also reported that, expectations with the expectations lower interest rates, there's a lot of corporate activity going on. Capital One announcing it was, planning to buy Discovered for $35 billion in an all-stock transaction. Walmart tendered an offer to buy TV manufacturer Vizio for $2.3 billion. Truist announced that it was looking to sell the remaining shares in its insurance brokerage business, a deal valued around $15 or $16 billion. So there's a lot of activity. It's more positive now. And to really help, discuss all this, we've got some great people here on the panel. We've got Serge Jonnaert of the Merger Company. Serge, you can give a little wave if you would.
Sure. Good morning, everybody. And thank you, Marty, for organizing a great event. So my name is Serge Jonnaert. I'm a 35-plus software exec and M&A deal maker, as well as former entrepreneur with 2 exits, one bad, one good. I recently left Corum Group, one of the larger tech investment banks, where I was top producer for 23 to start the Merger Company, which is a new tech M&A advisory in San Clemente, Orange County, that makes extensive use of artificial intelligence and robotic process automation. And this has definitely been part of a topic for the last day or so, and happy to inject some perspectives in the conversation on that as well.
Perfect. Appreciate that, Serge. Andrew Apfelberg, totally tripped over that. Andrew Apfelberg, who is a partner at Greenberg, Glusker, and thank you for hosting this event here. And I stepped all over it. You can fix it up now.
It's A-okay. My name is Andrew Apfelberg, and I am a partner here at this law firm, Greenberg Glusker, in the corporate department. I'm a former investment banker, probably the only one dumb enough to go that direction rather than this direction, which is why I'm still working. But be that as it may, I really enjoy what I do. I do a lot of work with family offices and high net worth individuals. I also chair our branded consumer products industry practice group and spend most of my time either getting companies ready for a transaction and then transacting, or helping some of my high net worth individual clients and family offices in their private investments. And appreciate you having me on the panel.
Terrific. And our third panelist here is Shawn Thompson, Managing Director of Diamond Capital Advisors. That was so much easier.
Yeah, usually people don't get my name wrong, although I get Scott. Anything with an S is fine. I oversee the operations of Diamond Capital Advisors here in Century City. We've got about 10 managing directors, and we are generalists, primarily selling companies that are owned by families or individuals, founders, and what have you. And we do some buy-side work, some cross-border work, and we also do valuations, especially where there's a conflict amongst the different partners or there's a generational shift where we can be that value add to bring sides together. We focus on every kind of industry we don't focus. We're a generalist firm, but we have some specific expertise in some areas such as photonics and instrumentation. We just closed a $90 million deal last week to sell RedWave to 908 Technologies. You can check out the announcement for that. That's in the photonics space. Healthcare, and then consumer products and traditional industries, whether be it professional services like law firms, accounting firms, and healthcare too, as I mentioned. So that's what I've been here in Los Angeles selling companies since 1994.
Great. Appreciate that, Shawn. Thank you. Of course, as soon as we start this, my nose decides it's going to start running and all sorts of fun. I promise I will mute my phone and blank out the picture if I need to. So thank you for your backgrounds. And my name is Mark Heil. I'll be moderating this panel. I'm a managing director with Pickwick Capital Partners, a FINRA registered advisor to middle market companies and alternative asset funds, providing investment banking and fund placement services. Over the next hour or so, we're going to have a discussion here on the topic of mergers and acquisitions. We invite our audience to participate in this. We want you, and that's when I say we, I mean all of us want you to participate. We want you to ask questions. Don't wait for the end. Interject when you have them, and the only thing we'll ask is be respectful of our speakers' time. There's a limited amount of time we have on this panel, so get straight to the point. If they need more context, they'll ask you for it. Something I always do is read a little quick disclaimer. I don't know if the attorneys did that up front, but we'll do it here, so we'll make them feel a little happy. Information is presented for educational purposes only and is not intended as and may not be relied upon as tax, legal, investment, or other advice. To the extent myself or the other panelists express an opinion as part of this discussion, those are our personal opinions, not necessarily shared by the firms we represent. Andrew, did I miss anything?
You're pretty thorough.
Sounds good there. Perfect. Andrew, I'm actually going to start with you. It's rare that I start with an attorney, but it's on mergers and acquisitions. But we had a good pre-screening call, and I think you raised some interesting points. Mergers and acquisitions in 2021 were very high, all-time records. And then 2023 were all-time lows, or at least lows for a decade, right? We just completed the first quarter of 2024, and if you heard, things are looking up a little bit. There's more activity, more things happening. But I'd like you to talk, specifically what you spoke about the other day when we had our prep call and what you're seeing in your practice right now. And then I'd like Serge and Shawn to follow on.
Yeah, no, thank you. It's sort of been a tale of two cities, as you mentioned. Certainly in 23, we saw much slower deal flow. We saw certainly changing of the terms, went from being a seller's market to a buyer's market. There's no doubt about that. Deal structures changed, valuations changed, and overall volume decreased. I would say that my experience so far in 24, and I don't know if this is representative of the industry, things are back to pre-23 levels for my practice. By the end of June, I'll have closed, just as many deals as I probably did in all of 2023 by mid-year this year. That said, the mix is different. I would say that they tend to be a bit smaller, or there tends to be a little bit more hair on the deal. And I would also say that the percentage of time I'm on the buy side has increased significantly, as many strategics are using this as an opportunity to pick up market share, to horizontally or vertically integrate, or just opportunistically, acquire clients or R&D or what have you. So it's been a very good time to be a buyer. And so, been spending a lot of time doing that for my strategic clients or for my family office clients.
Serge, why don't you tell us what you're seeing?
Yeah, well, I've been on non-op in getting this new firm off the ground for about 2 months, but I would definitely concur. We already saw some of that in the second half of 23, where we have a little bit of an imbalance in the supply and the demand. Of course, on the demand side, everybody's looking for the larger, cleaner, more profiled opportunities. But what's available in the market are definitely some of the smaller and sometimes immature companies that do indeed have some issues, maybe on the cap table and what have you. So,
Sounds great, Shawn.
Yeah, I would say that, our firm is so small. I often tell people you can't tell about the volume of the market from our flow. But I can tell you that, consistent with what Andrew's saying, deals got pulled forward kind of into 2021 and then started going on the decline. So last year was the lowest year for M&A. I track deals under 500 million. We're most active under 100 million, but under 500 million last year was the worst year since 2003. This past quarter was lower than the quarter before and lower the quarter a year before that. And so that being said, so that's in terms of closings though. In terms of pitches, whereas last year it was not none. Because I see some on my pitch sheet now that are still from last year, it felt like none. And this year we have seen, what I would say is if I'm doing a 1 to 2 pitches a month, 2 pitches a month would be 24 in a year, that'd be a lot for us. This year already, we've had at least 10. I know we have 8 active prospects now, and we've, a few have gone by the wayside. And that is really just through April. And so the flow is definitely on. There's been a lot of talk at places I've been at other events about lower quality deals. And I think that is the case. I think people are still suffering. They're thinking multiples should be what they were or should be higher. And again, multiples have not changed much. Under $100 million, maybe multiples have gone down a point since 2001. That's what the data says. It says exactly 1 point. But I don't, for good deals, they can get done. But I think a lot of people have been waiting and waiting. And now the ones that are coming to the market are the ones that have to for one reason or another. Just had a call yesterday that was of this, where financial pressures are saying, look, I thought I could wait, could keep waiting, but I can't. So we've also seen, and I don't know what this is, it seems like this is a lot more sophistication on the buyers. Most every client I come across is saying, I had these bids during COVID and they couldn't get to this multiple. Both the effect of private equity and family offices money and management in businesses, I think is profound. When I started in 1991, there were 500 private equity firms. And now there are 5,000. I don't know. There's certainly more than 3,000. So but the volume is not there yet. And so there's been a lot of activity, good for you. And thankfully we closed some deals too. But that's what I'm seeing is I'm hopeful. I hate to prognosticate, but I've been thinking 2025 was when deals would come back. And then when all these pitches came in, I was like, oh, this is great. We're going to be signing up deals left and right. So anyway, that's my lower middle market, dozen person firm analysis. Yes.
I love you. Great opening. My question is, what's the wall? What's holding up deals getting done? And why was last year so bad? What's holding it up? Is it money? Is it interest rates? Is it just apathy from the buyers and sellers? They can't come to terms. What's the holdup?
You want to repeat the question?
Sure. So the question was, what is the holdup? Why aren't deals getting done? Why didn't deals get done last year? Why are they not this year? And I'll give my interpretation of the zeitgeist. What I think people are saying and what I see is that there was, if you look at the data, you'll see a big shift. This is the past, this is the future. There was a big shift of deals in 2021 and such. Remember all the talk about oh, capital gains are going to change. We need to get these deals done. There was this urgency to get deals done. And I think that cleaned out. If you look at the trend, it sort of brought these deals forward. So that ebb afterwards is pretty natural. But then you had the rise in interest rates, which disrupted the market. It certainly, and I know I just got finished saying there's capital to get deals done, but certainly there are now costs to borrowing in the real estate market. You can do as well with a debt fund as you can in an equity fund. So I think those multiple, just that the multiple expectations versus the multiples that were available in the market caused it. And also buyers there's always this fear of operational risk, fear of catching a falling knife. And then when the markets are also going against you, it brings about what Andrew was talking about, different deal structures. So instead of, oh, we shouldn't even do earnouts, it's, you know what, maybe we can get to our headline price with an earnout. And I'll get to that story later.
Yeah.
For me, I would say that uncertainty is the killer more than anything. I've been doing this since '96, and from what I've seen, obviously there's ebbs and flows. There always is. But I think the part that really kills deals is when people are unsure. They're feeling insecure. They're feeling unsafe. They're looking at, well, shoot, if I just put my money into a mutual fund, right? Or if I'm putting my money into even a money market with these interest rate environments, I'm gonna get this kind of return. So I need to feel really good about the risk reward profile to take on that additional risk, because for our family office clients, this is just but one asset class for them, right? And for PE funds, they're obviously in the business of making money instead of losing money for their LPs. And for their LPs, the private equity is just one segment of their endowments anyway. So when there's uncertainty, whether it's political uncertainty, interest rate environment uncertainty, world events like invasion of Ukraine, COVID, anytime a stock market, even though it has nothing to do with, in real life, with private businesses, whenever there's that level of uncertainty, people just stop. But once there becomes a relative period of calm or stability, no matter where it is, high interest rate environment, low interest rate environment, obviously the Ukraine crisis is still going on, people re-engage. They will adjust deal terms. They'll adjust valuation. They'll maybe not be able to borrow as much money in the high interest rate environment. So they force the seller to roll, or they'll force an earnout, or they'll force a seller note. So people adjust through structure, but they're only willing to do that when they feel safe and secure and stable.
Quick follow-up question.
Yeah.
You're an LP in a fund. I don't care if it's BlackRock or Apollo's or whoever. If I'm an LP and I just gave them $1 million and this environment is stalled, they're clipping fees every year and they've got dry powder. What do I do as a PE guy, as an investor?
So the question was, for those who couldn't hear, if I'm an LP in a PE fund and I've just put in, made a capital commitment to the fund, and the fund is obviously taking, the general partner is taking management fees, but I'm not seeing a whole lot of action. How am I feeling as an LP? Is that a fair summation? And at least, my clients who are LPs in many funds, they're sort of okay with it.
Yeah.
For the most part. I found that sort of like the pension funds, my family office clients have a desired overall allocation to the private markets. And as the stock markets drop, even without changing the absolute dollars, the percentage interests or the percentages change. So they become over allocated to private markets or over allocated to PE. So they are more than happy to not have their capital called, right? Because for their own organizational guidelines, that helps them to stay within the desired overall diversification that they want. On the other hand, what you're feeling is much more, I think their pressure has been, hey, GP, you need to start selling. we're less concerned with you buying and much more concerned with you selling, because we want to get some capital back and we want to see what you can really do before we re-up for the next fund.
Let me just add one thing.
One question and we'll get to Serge.
Can I add something to that?
Serge, hold on one second, Serge. So I think post 2008, 2009, there was a lot of litigation on capital calls, which ended up extending the ability to call capital, but it became more difficult. And I think that the outcome was that it's not good public relations for PE firms to make capital calls in bad markets. Right. And I think that a lot of PE firms learned that, and venture capitalists as well learned their lessons on that. So anyway, that's just a comment.
But that's the biggest problem, is that that's the best time to call capital and take advantage of opportunity.
That's right.
But a lot of
That's
people
right.
want to be involved in it, right? I'm sure there's stern letters that are going out to VCs right now saying, do not call our capital, we'll litigate. And it's cheaper to
Well,
litigate than to get to.
And then there's also these they're doing these dividend forming these exit vehicles and buying it from themselves. And it allows, I'm not saying this in a negative way, it allows them to roll it over. Those people that want their capital, get it out. Those that want to stay in that asset class can keep it. And the rise of those, I don't have any pictures with me or anything, but it's been incredible last year.
There's been a decent number of those. Serge?
Yeah. Wanted to add something, and also a little bit of that reflection on 23, because it's all tied together. One of the things that we saw towards the end of the year for 23 is, I would say, a little bit of a panic with a lot of the PE firms, especially in tech, that still had quite a bit of capital to deploy. And of course, what we see is that they're all gravitating towards the grand prize opportunities. They're all kind of chasing the same deals. And unfortunately, there can only be one winner, right? There can only be one acquirer. And that leaves a lot of companies that kind of time after time just miss out on opportunities. And that angst definitely builds up towards the end of the year because they need to deploy that capital. And I think that's one of the things that where I do believe, especially for family offices, where a lot of the opportunity lies, instead of just setting hard thresholds, which a lot of firms do. They basically say, okay, we're only looking at anything that is $5 million or $10 million in revenue, $1 million to $1.5 million in EBITDA. Just below that threshold, there's a lot of companies that have already proven themselves operationally, that have some great products, some great market potential, but are just not getting any mind share because they're just below that threshold. And I think that's hopefully going to be a segment of the market that's going to get more attention in the months and years to come. So,
yeah, I think, the speed of the market also plays into this, right? So when there's less competition, you can go slower on a deal. You don't have the fear of missing out going high. So I think that is something that really plays into it. And I think it also plays into the comment that Andrew made a few minutes ago about more hair on the deals, right? When you have to move faster, you don't have time to look at all that hair necessarily before you make the LOI and make the bid. And once you're there, you're sort of at a point where you want to move forward and get it done. So I think that also plays a big role in what's going on. So I think one of the things we'd like to really go towards right now is, one of the big stalling, one of the reasons that the market slowed down was because of the price differential, the ask and bid price, right? And, one of the things that settled out, and I think Andrew alluded to this, is that, people got comfortable with where they were and they understood what the market's now offering and where the highs and lows are. But there are also some mechanisms put in place to help make the transactions go through. And maybe I'd like to have you guys just comment on what mechanisms you use to help close that gap and to get things done.
Anybody want
Sure. So, I mean, look, I wrote down, it was one of my notes over here because there's a lot of discussion of AI and things like that. But look, what I do is act as a quarterback for a transaction because I'm getting paid when the deal gets done and most likely, losing money otherwise. That gets the motivation very, very sharp. So, for instance, we're working on a sale of a school here in Los Angeles and Hollywood that does graphic design. They're getting bought by an international buyer. The Department of Education is involved in accreditation entity is involved. And we're really down to the short strokes, and we've got legal experts on both sides. And on the other side, this attorney, very well respected, very well known, very wry sense of humor, but he's not in a hurry. You know, we just had to have an emergency call yesterday because the investment bankers on both sides are saying, what's going on? It's been 15 days since we got this letter, and how do we push it forward? So for me, the mechanism is the buyer wants to get the deal done, and the seller wants to get the deal done generally. And once you have that, then you have to pull on whatever levers there are. I was just talking about a deal that we closed, we did close in 2023, that we had a private equity buyer. This is, I hate to speak badly of anybody. This is a private equity fund that is large, and in the past has had a reputation. They were like the firm that was known for doing schneids on the purchase price after the diligence
What
was
is that?
a retrade on the purchase price. In other words, that is what we used to call it back in the day. This is a long time ago. But so we were working with a client that had about $7 million of EBITDA. During the transaction, that EBITDA went down to 3, and the client lost their biggest, our customer lost their biggest client. They still did the deal at the same headline price. And the reason, and yes, there was an earnout that got added onto it, but the reason was the strategic benefit. They wanted the manufacturing capabilities of my client. Didn't matter if they were losing money. Sure, they didn't want that. They wanted that piece of business. But for so for me, if I have a strategic lever I can push on, I'll do it. I had another deal I had no control over. My client decided to go with a foreign buyer that I knew was not going to be able to. I knew they were never going to get there, but the client decided to go forward with it and had side conversations, did a whole thing. So if I, come to the end of it, we just had to get out of that relationship after months and months and months of not litigation, but we're paying litigators. And so that's what I do is, and it's not different than any other time. And often with the investment banker will be known as the person that got that deal done, because they're up in the middle of the night going through databases, figuring out inventory, turns if that's what's needed. Sorry if that was too long of an answer.
And I'll approach it a little bit differently. What we're seeing is folks aren't necessarily selling the whole company. They'll perhaps sell a division, or they'll sell, a majority of the company and keep a division, right? Because, either that's something that they think more favorably of than the buyer in terms of future prospects. But you're seeing some of the old traditional structures, earnouts, obviously, as a way to bridge valuation gaps and allocate risk, requiring rolling of equity, and sometimes even requiring it on an after-tax basis rather than on a tax-deferred basis, because you physically need the cash on the balance sheet. Seller notes are back with a vengeance. We're also seeing a lot of interesting conversations around, do I just do a majority deal rather than buying the whole thing? And I'll say like a lower end majority, not like a 95% majority, more like I'm gonna take 60% now with a call option on the rest, that I will or will not take on my own volition. In some cases, we're even seeing a minority deal with an option on the rest of it. And for sellers, those can be attractive because they'll look at it, now it's a higher interest rate environment. They're less excited about the seller note because previously you were able to charge an interest rate higher than the prevailing market rate for the enhanced risk. Now you can't really. But they're really gravitating towards either the low majority deals or the high minority deals, because they're like, well, if valuations are lower now, terms are worse now, let me at least take a few chips off the table, hopefully get the help that all these funds say they're going to provide, and then I can have my bigger exit later.
Serge, why don't you jump in?
Yeah,
I have a question, Serge.
Serge,
just one quick question.
Yeah.
So you're seeing more carve-outs and more owner financings.
Oh yeah.
And so those are almost like special situations at this point, right? I mean, it used to be more common in 2008, 2009, you saw a lot of that, right? So we're kind of going back to that cycle again. Well, with higher interest rates, are you seeing anything new in that space? Because I mean, the carve-outs, a lot of large conglomerates are getting rid of non-performing
Mhm.
divisions, right? Actually, we had a healthcare company come to us and said they were part of a public company and they were carved out, and the company kind of gave it to the person who was director. He said, look, we're gonna retain 20%, we'll give you the 80%, make it work and go raise your own money. So you need to raise $20 million just to make it survive, right? So we're seeing a lot of that, but you're saying, what percent of these sorts of deals are you seeing? Are you looking at lots of deals or special situations, 10%, 20%, 30%? What do you think?
For the role or for the seller finance part of?
All of the above.
I think
Do all of the above have some kind of special wrinkle? Like, are you saying most of your deals have some kind of
every deal has at least one wrinkle.
Wow.
And many deals have multiple wrinkles. The way I try to describe it to folks is you're putting together a jigsaw puzzle. You got to put all the pieces together to make the whole. And, for an A asset, less puzzle pieces, right? For a B asset, you're going to have more. I'm working on a deal. I negotiated an LOI last night with one of my colleagues who's here in the room, where they required a roll, they required some seller financing and an earnout. So we had all three.
Wow.
And that's not uncommon these days.
It's interesting you say that, because that's some of the things this buyer wanted to pull on us, is they wanted to buy a minority and have the right to buy the rest. And we're like, well, you can have a seller note with a guarantee. But it was interesting, so because it was some of those tactics that I had not seen in a long time. I want to let Serge. I know Serge was going to say something. I have an answer on this carve out thing, but I'm not sure it's.
Yeah,
I'm not sure it's too general. We'll come back to that.
I wanted to piggyback on the value gap question, though, because that's definitely something that features prominent on the minds. I mean, everybody, of course, wants to get the highest value, the best deal structure for the company. And absolutely the best way to address that is to create an auction environment, to create some competitive tension, have several parties around the table kind of bidding each other up and negotiating back and forth. And at the same time, it really comes down to the storytelling, to creating some, we always say, okay, sell, and then sell it again, because sometimes, especially when you go through due diligence, all parties lose perspective as to why they want to get the deal done. They get so mired into the detail, right, that they kind of lose sight of why we're basically negotiating a deal. And I find that the whole psychology there is very powerful, because when you have 4 or 5 parties negotiating back and forth, the worst thing that can happen for a corp dev person or somebody who does the deal sourcing at a PE is to go back to their board or their senior team and basically say that they lost the deal over $500,000 or $1 million. I mean, at the end of the day, they're people as well. They want to achieve something. They want to get a deal done as well. And I think the whole psychology piece of it features prominent in that. So
absolutely on target there, Serge. Interesting though, I do find that when you're trying to create those, now you have to leave a little more time, because people don't pick up and rush into deals the way they did 2 years ago. So you need to give them, you have to set realistic expectations with the seller. Here's what it's going to take. And you got to allow the buyers the time to get in there on the realistic. If you call them up, say, hey, you got a week to do this, you're not going to get any bids. It's just the mindset of the sellers right now. I mean, the buyers right now. I want to toss it back to you, toss it back to Shawn. He was going to comment something. So.
Oh, in terms of carve outs, I think what Andrew said is right, that every deal, we used to say every deal will die at least once. Each deal has one complication, but I don't want to take my low volume as a trend, but I'm looking at several carve outs right now. I just finished a special situation for a company that got out over its skis on the East Coast, and we had to sell off a line of business and a line of equipment. And I'm pitching on a foreign snack food manufacturer that did the same thing here in the United States, that we may be selling off some profitable lines of business. And so, yeah, this is a carve out, but it's really a special situation. So I think it's indicative of, for this company, it was a supply chain issue. They're gluten-free, and one of their ingredients went sky high and hasn't changed, and their margins got compressed, and the ability to change that pricing on the fly to your consumers is limited. So you're stuck. Other companies, I was dealing with a leasing company that this was a bankruptcy attorney referral that was hoping not to file, a leasing company that had a whole lot of assets and their loans were turning over at higher rates. So they had lots of EBITDA, but their balance sheet was screwed up. So I think for sure we're seeing a lot of those sort of challenges. And this goes back to that quality issue in the assets. And I think I couldn't agree more with what Serge is saying in terms of but I think everybody knows what we do is generate a process where there is competitive nature, right? That's what we do is outside the bounds of interest rates and this and that. I got a company to win a deal once, but the board said, X is no good. We want X times 1.5. And I went back and said, here's what you have to win the deal. And I called both. I walked out of the conference room, called them both up, and I said, here's what you have to win the deal. You're going to do it? One of them said yes, and they closed the deal. There's no reason for it. And so that's not going to change.
The only thing I would add is not all carve-outs are distressed situations. I mean, we just had a deal announcement yesterday of one of my clients that bought a division of Cargill. And obviously Cargill's not hurting, nor was my client. But it was a strategic opportunity for my client to expand some capabilities that they didn't have, and that from Cargill's perspective, my guy could do it better. And so it just sort of made sense for both of them in terms of their strategic initiatives. So I think we're seeing, some of that now, again, in response to, the current environment, the current valuations, current deal structure environment.
No, I think you're seeing a lot of that.
Mark, I have another question. So we live in like this tentpole economy where there's like 5 companies that have huge stock market, public valuations. All those companies have acquired about 250 other companies in the last 25 years. They acquire about 10 companies a year. So that's Google, Facebook, Microsoft. Do you think those guys are slowing down? And also, do you think there's more trepidation or new negotiations as they look to make deals happen? Because their cost of capital is higher, they have their cash laden, right? Do you think that those guys are continuing to do acquisitions at the same pace?
Absolutely, yeah.
Okay.
So a lot of the deals we've done with actually the companies you mentioned, they're not structured in a traditional way. First of all, many of them are done as what's called a talent acquisition, where really, I'm going to basically pay you to let me hire all your people. And that's the main thing we're going to get. You keep your receivables, you keep your payables, you wind down, and you get this little kicker for letting me basically hire all your people. Obviously, low risk for the buyer. For the seller, it can be great, but even though some of those folks have, immense amount of cash on the balance sheet, they're not really using it. It's a small portion in cash usually, and a significant portion in their stock, which people are more than happy to take right now, because you look at it, okay, I sold my business for X, but I got a whole bunch of Google stock, or I got a whole bunch of Facebook stock or Apple stock, whatever it may be. You look at their historical trends, you say, gosh, I'll ride out the lockup period and then hold it maybe a couple more years, and I could potentially double what I'm selling for. So they do things a little bit differently. They're in a class of their own.
Yeah, I would second that and say what we see a lot from Amazon and the Google and their venture arms is corporate venturing a lot. Or for instance, we had a client that is doing, they're not ready to sell. They have a company that does post-production of, they do translations for documentaries. And they have a technology that allows that to be automated. And Amazon invested in the first round of funding, and now they're investing in another round of funding. And so they'll have the rights to it. And so they basically get this, okay, they didn't actually give them any money. They gave them a rebate on their Amazon Web Services account.
Yep.
And so I think you see this all over the place in the food space as well. There's lots of food venture arms. So they're not necessarily going to buy your multi-cuisine, AI-driven robot chef, because they just invested in 3 others. But I think it's alive and well. Absolutely. The sophistication, again, it's similar to in the entertainment industry. If you get a deal, by the time a deal comes to me, I know it's a tough one, because if it was a good one, CAA would have been handling it, or it would have been handled through normal channels. But I think those normal channels are changing a lot in each individual space, industry space.
I'll
Yeah.
tag on that. Just a quick story here. So I know a venture capitalist who sold the business to Google, and he realized he got a premium on the deal. So he thought, being a smart venture capitalist, I'll go to them and make them a deal to, negotiate deals in the future for them because they paid way too much for my company. So he goes to Google and says, "You paid way too much for my company. You should hire me to help you negotiate these." And Google says, "We pay premiums on all the companies we're buying because we want the deals to go fast." You're not needed.
Mark, I'd love to add something to that though, because I mean, to Marty's question earlier, the leaderboard will change year over year, but it's always the same parties: Amazon, Microsoft, Deloitte, and the likes that will, especially in tech at least, but they're not necessarily also the best parties for, especially for small or mid-sized tech companies, because I mean, they've got very seasoned corp dev people, and it doesn't matter whether they're sitting on billions of cash, they will negotiate for every single penny. And I've found over the years that there's smaller companies sometimes that are in ancillary spaces that equally have the means, will pay a much higher premium than some of the big names, the big coveted names that everybody wants to be associated with. So
Absolutely. So I guess what I want to talk about here a little bit is, we talked a little bit about consumer companies. We talked about agricultural type companies. Where do you see the hot spots for M&A moving forward right now? Where's the demand, and where's that demand coming from? Who's doing the buying?
You mean in terms of what industries, by and
Yeah,
large,
what
are
industries?
like private equity
Yep.
and family offices looking at?
Yep. Well, I think or corporates, right?
Well, for the past couple years, as odd as it'll sound, the hottest market has been home services, HVAC, plumbing and heating, solar insulation. A lot of the major private equity funds across the country have launched roll-up vehicles. One here local in Los Angeles is Leonard Green. They have a roll-up vehicle called Wrench Group. We probably have sold 3 or 4 companies to them. HVAC, home heating and air conditioning, plumbing. What they're after is recurring revenue, because what happened in these industries is, first of all, it's a perfect for a roll-up, completely fragmented, oftentimes very small operators without a lot of business sophistication, but they have some good market share and stickiness with their clients. But the thing that folks just sort of lucked into in that industry is it became a perfect combo of project-based income. I'm going to replace your water heater. I'm going to do a solar installation, which comes around every couple of years, but it's a big ticket item, with the regular maintenance. And what a lot of these folks did, which is what PE really was after, were these service contracts, where I'm going to pay you $10 a month, and in exchange, you'll come change my air filters once a year, right? And I'll get a discount on when I got to replace my HVAC. Well, very few people actually take advantage of it. So the actual expense against that income is low, but it's, an annuity there. Folks don't, the churn is minimal. So once you get folks, they stay. And then it just becomes this monthly coupon you clip, and it's perfect. And honestly, it's the most brilliant sales mechanism ever. Like, I'm going to come into your house and change your air filters for free, but suddenly I notice, hey, by the way, this isn't working so well. You want me to fix that? Or, gosh, my affiliate who does water heaters, they might be able to replace that old one for you. So it's actually, these service calls generate sales. It's brilliant. Wrenchworks is one. Service Champions is another. We probably sold 6 companies of Service Champions.
There's not a market with those funds.
What's that?
Are those funds still open?
They're operating companies.
Are they still raising capital?
I don't know, but I can tell you that virtually, well, I shouldn't say virtually. There are many big PE groups that have launched roll-ups in this space, for sure.
It is kind of at its high end and gone down a little bit, but
Yeah.
Tech-enabled business services were huge, are huge, those buzzwords. And now, people are still looking for, I would say the buyers are looking for what is in their space. So I look at less of, advise me on how to start up a fund to get to a hot space. But I do think that is absolutely the case. What we've seen everybody in their whether it's white collar or blue collar services, businesses, like engineering services, I sold a company in that space, strong concentration of revenue in the founder's hands, small business, and we sold it for almost a 10 times multiple, $2.5 million of EBITDA. And we got 2 million of EBITDA, is over $25 million purchase price. He's just about to hit his earnout. I think I don't like to, I don't know if I'm on top of what's hot or not, but for instance, drug testing was hot, or pee testing. Like I was selling a company that was doing testing. There was a whole roll up and public companies in the space. And then right in the middle of my transaction, it all went dead. And the buyer calls me up. He says, I'm being fired, basically. This company is not going to be making any more acquisitions. So it does stop sometimes when they realize, there's no money in pee testing and it's going away, for instance. So, but I don't know if I know anything else that's hot. Serge, what do you see that's hot?
Yeah, I mean, Shawn, I'll second you. Tech-enabled services. I mean, this is kind of a migrating away from just the pure SaaS recurring revenue, where all of a sudden people are realizing that it has a real service component to it as well. I see a lot of interest in more vertical AI applications, anything from GIS, forestry, civil engineering. I mean, you name it, not just kind of the general AI applications, but specific vertical, even industrial market segments. AgTech, I'm very bullish on that, as well as blue collar kind of field applications. And another area where we see a lot of interest right now is RegTech. So anything to do with compliance, regulatory compliance, both globally, internationally, as well as here domestically. So
I don't know if that's good news for Andrew. He doesn't do regulatory work. He doesn't care. His partners care. Andrew, I thought the other day you mentioned something about the food processing business, that you were seeing a lot of deals there. Do you want to comment on that? Or did I get it wrong? It was Shawn who mentioned that.
That was me.
My apologies.
We're fairly active in the food space, both food manufacturers and brands, and that was one of the carve-outs I was just mentioning, where companies gotten out over its skis, built this beautiful facility that's at about 50% capacity, and they're losing money. But in the hands of another buyer, now it helps that I have another client that I just finished selling off their facility, and I was able to call up 3 buyers and right away get a sense of what they would pay. And this is a really good example, and I wanted to talk about this for the family office. Now, I'm glad you reminded me, because one of the people that I called was a family office that I know is active in this space, and I said, hey, here's this opportunity. I know you have these other companies. What do you think about a facility in? And I told him the region of the country. And he said, yeah, I might be interested in that. And here's how I would do it. And he was able to lay out the pricing, because he's the decision maker. He's handling. And so, sure, I made some other phone calls too. One was a private equity. Another one was a private equity backed strategic. But I think, food is an area that has been challenged by, we've got another company that would like us to help him sell his business, where his brand is too small and he's just not able to get traction. And if you're dealing with contract manufacturers and you don't have control of your gross profit, you can't do anything. So I think we've got some challenges here where we've got the bigger players. I'm not sure where General Mills and all these folks are going to end up. Frito-Lay, they're getting boycotted from their pricing practices and things like that. And so it'll be interesting to see what snacks, if any other snacks, come to the fore. I don't anticipate it, though.
Absolutely. And I think you raised a very good point. When money gets tight, people look for people who have the connections that can get them the money to get their businesses to where they need them to go. The value of the broker. You guys did an excellent job. I see Marty's up there with the cane. He's yanking at us. Marty, we thank you for the opportunity. I thought they provided excellent conversation and great examples too. So thank you so much.
Great job, guys. Thanks so much.